Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
Crawling back from the worst day since 2022. Futures rebound after a sellout wipes out $1 trillion off the Nasdaq 100. Prepare for concession. Secretary of State Marco Rubio outlines what's his roadmap for peace in Ukraine. And Delta warns on the economy and cuts its profit forecast in half. Good morning, Manus.
Danny, good morning. The very essence of U.S. exceptionalism may be on pause, and that narrative everywhere from Delta through to Ed Yardeni. Don't panic yet. Citi say exceptionalism in U.S. equity markets, which are trying to find their feet this morning, is on pause. The S&P on the brink of a correction. Consumer discretionary is the only sector which is fully corrected. The Nasdaq, the worst day since 2022, again trying to find its footing this morning. The Mag 7 is off 6% yesterday, down 16% for 2025. To the bond market, 24 hours ago, we looked at these bond markets. They were down by 5 basis points. The 10s collapsed by 10 basis points. And suddenly, we're pumping up a much earlier and more aggressive Federal Reserve. 83 basis points of cuts potentially this year, 40% probability of May. So suddenly, Danny, even after the New York Fed inflation, steady as she goes numbers, this market at the moment is definitely looking at a risk reward towards 4% rather than back at 450 at the moment.
Yeah, that move in equities is a rebound. We opened in the pre-market session down by nearly 1%. Part of the souring attitude also came in the form of earnings. Here's what we saw yesterday from Delta, and the pain continues this morning, down nearly 10%. It cut its profit forecast, lowered its guidance for revenue growth and operating margin. Most notably, and maybe this is why it upset wider markets, it cited weakening travel demand with consumer spending and consumers in general under pressure.
And Tesla rebounding after the worst day in more than 4 years. It came after growing concerns on Wall Street about demand for the company's electric cars.
And by the way, Trump said that he would buy one to support Tesla. So if you want to know where the Trump put is, it's with Tesla stock. Meanwhile, Oracle down 1.8% in the pre-market. Trade sales and profit forecast for the current quarter fell short of estimates. Still, it did point to a surge in bookings and also said that its growing cloud infrastructure business will boost revenue.
In just a few moments, we will address some of those market concerns. Ella Hoxha of Newton Investment Management. Later in the hour, Laurie Calvasina of RBC Capital Markets. That is a brilliant image. I've got this image of this gold Cybertruck, Donald Trump in it, with Elon Musk on the other side, doing a victory lap down Pennsylvania Avenue. There's an image for you this Tuesday morning.
Yeah, but it's kind of the point that, like, he'll step into the market for Tesla specifically, but not the wider market. I thought it was really telling that White House officials yesterday were asked about this market sell-off. Their response: we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from businesses and business leaders, and the latter is more meaningful. So they're saying business leaders are still okay, and notably, Trump is going to be meeting with business leaders for a roundtable today. We'll see if they can throw him off some of this idea that he shouldn't be stepping in, or maybe make him enact tax cuts quicker.
Yeah, well, we've got Jane Fraser, Jamie Dimon going to the White House. What are they going to say? There was a hurrah moment that these deal flows and deal tickets were going to come piling in. That simply hasn't happened. On the IB with Tim Graff over at State Street, and he says, calm down a little bit. Put this in perspective. The S&P 500 is back to where we were 6 months ago. Your risk is the CPI tomorrow. We were talking about vol and vol shocks. He said, just restrain the language. The biggest risk is that you go into tomorrow, and that's where you have a much bigger risk on the CPI, and that could give you a risk parity moment.
Yeah, the economists are seeming worried, though. Mohamed El-Arian writing in the FT this morning saying, essentially, even if the journey, the destination is a good one, the journey could be a problem, that a bumpy journey could shake confidence in the U.S., and that will undermine one of the greatest strengths of this country, which is that confidence in our institutions.
Absolutely, but of course that takes the consumer. Let's talk about this volatility. It's driven by recession fears. It's cutting through the market. Citigroup downgrading their view on U.S. equities to neutral, citing expectations of negative U.S. data. For the White House's reaction to the recent sell-off, we're joined now by Kevin Whitelaw. Kevin, I want to pick up on what Danny said, which is you got the business leaders going in there today, from banking to Cisco. And there's a great line from Neil Dutta over at Renaissance. Powell is not ready to pivot, and Trump has no reason to turn the dial back. Do you think that those voices from business will be pushing for a switch in the dial today? Good morning.
Yeah, good morning. Look, the businesses have a complicated sort of message that they want to, go in there. They came in very excited about elements of Trump's agenda. Many were very much in favor of the deregulation agenda. They're looking for ways to free up the ability to do business more quickly and more with more flexibility. But they're also looking at particularly this tariff fight, which is emerging, and that is really alarming a lot of them. And just the unpredictability of it is making it incredibly complicated for companies as they try to figure out how to do some medium to long range planning. And so, they are going to try to figure out how to calibrate that message to Trump, understanding that, he's often not receptive to criticism to his face, as I think the Ukrainian president found out recently.
Yeah, but at the same time, Kevin, it was the automakers who convinced Trump to step back or at least give a delay in auto tariffs. So maybe business leaders can do the same thing. Trump has a lot of influences coming in right now, along with the business leaders. He constantly has Musk in his orbit. Yesterday, Musk was on Fox talking about entitlements, saying most of federal spending is entitlements. So that's like the big one to eliminate. How is that going to go down on Capitol Hill, Kevin?
Well, in any other previous political era, that's what we would call a gaffe, to come out and say the thing that your opponents have been accusing you of wanting to do. While you're denying it. President Trump, in his campaigns, had always talked about protecting Social Security, but obviously with Elon Musk using the word eliminate anywhere near that entitlement spending, that's red meat for Democrats who are obviously extremely worried about what that's going to mean and what that's going to mean for obviously the millions and millions of Americans who depend on that money, and with sort of the access that Doge has had to some of those accounts, with the lack of transparency over what exactly is happening there, and all of the changes in leadership, there is a lot of concern about this, and this is only going to feed that. So that is going to concern lawmakers, not just Democrats, but also a number of Republicans.
Kevin, the momentum to some kind of a cessation of hostilities between Russia and Ukraine is building. Rubio, on the way back from Saudi Arabia, made it very clear that Ukraine's going to need to make some territorial concessions. So what is it that the Russians are going to want before they go for that cessation of hostilities?
Well, the real question here is, what is Putin feeling any real pressure to come to a peace deal? He's obviously been feeling like he's got a somewhat stronger situation in the way the war has been going, been gaining bits and pieces of ground, been able to inflict some damage in Kyiv, and seems to have a much more sympathetic voice in the White House, someone who's much more critical of Ukraine. And so in that sense, the real question is, what is Trump going to do, if anything, to force Putin to the table and to really actually make some deals? He's going to be looking for guarantees that there won't be a real NATO presence in Ukraine. He'll probably be looking for restrictions on the size of the military, and obviously looking for as much territory as he can get. In that, Ukraine, meanwhile, is going to try to figure out how it can come up with some kind of situation that will not simply allow Putin to regroup and then launch another attack in a year or two or three.
Kevin, we really appreciate the update this morning. That is Bloomberg's Kevin Whitelaw. Let's get you some other stories now that are trending on the terminal this morning. Volkswagen expects profitability to remain roughly flat this year. The car maker bracing for lots of challenges, from trade tensions to declining sales in Europe. It's also under pressure to stabilize China performance, where it's been losing market share to local manufacturers like BYD.
Germany's Greens are hoping for an agreement in the dispute over defense spending. The party's co-head spoke to Bloomberg on how likely a deal could be.
We have been ready to negotiate since the night of the elections. We have been surprised that there has been nobody really engaging with us seriously.
Do you think it's likely that we could get a deal by the end of this week?
No, I really hope so. I'm like, the situation is dire in Ukraine. We really need Europe to speed up its own defense.
Elsewhere, YouTube star Mr. Beast's company, Beast Industries, generated $250 million in sales from its chocolate business. Feastables, that was last year. Over the same stretch, his media business, which includes his YouTube channel, his reality TV show, produced similar sales but lost almost $80 million. Beast Industries is currently looking to raise a couple $100 million to expand its existing divisions. So chocolate, that's the moneymaker, not media. Anyway, we are going to cover the market sell-off, bond yields falling 10 basis points yesterday. Newton's Ella Hoxha will be joining us next on Your Brief. It's your Bloomberg Brief. Danny Berger and Manus Cranny here in New York. A couple things, Manus, yesterday upset markets. For one, Trump saying that he's not denying that a recession might happen, but then concerns about the consumer. We got this from Delta yesterday in their earnings. They put out this statement that the outlook has been impacted by the recent reduction in consumer and corporate confidence caused by increased macro uncertainty, driving softness in domestic demand. Even before we got that, we had the New York Fed survey of investor expectations. And in that, you had investors, consumers rather, growing more pessimistic about their finances. About 27% expect their year-ahead financial situation to be somewhat or much worse off, the highest level in 15 months. Joining us now is Ella Hoxha, head of fixed income at Newton Investment Management. Ella, some of the sentiment readings continue to sour. Some of the businesses are telling us that consumers are worried. How much of what we're seeing in markets is just vibes, is just a retrenchment of things that might have gone too far, versus an actual change in economic fortunes?
Well, we had to price out quite extreme consensus coming into markets this year. And as we like to say, a contrarian approach actually has paid off quite well, particularly over the last few years. And we believe it's the same this year. So you take out some of that steam from whatever was priced coming into this year. But then on top of this, I think you're adding quite a bit of uncertainty, which is warranted in the sense that we have a policy backdrop ahead of us that we have to process and digest in a very different way. So you take away some of that optimism, I guess, and give way for uncertainty around what might be happening with short-term inflationary pressures, what's happening to growth, what's happening to jobs, because there's been a deterioration trend there in place for some time now. And so I think that's kind of fair and warranted, I guess, to have a bit of uncertainty going up and therefore sentiment souring down because of that.
Ella, in 2 very short months from whence we were in Davos to where we are now, there's exuberance around exceptionalism in the US. That is now being questioned. But a lot of people are very hesitant to throw in the towel on US assets. We're not at that point by any stretch. So where are we in the recalibration?
I mean, look, I think my view at least is that we probably need to tone down expectations further over the short term. And what we've heard from the policy put element that the markets have got accustomed to, let's say, at least over the last 14, 15 years, that there should be a pricing out at least to some extent of this put option. Therefore, I think at least from an equity stance, a lot of the darlings of the trades that we've seen over the last couple of years, as you see, are getting dented. But this is also where a lot of concentration has been in markets. And we've talked about this level of unprecedented concentration in certain sectors in equity markets. And so I think you have to at least price some of that away and then maybe give way for an increase in probability that there is a risk here. I'm not going to say, a certainty, but there is an increased risk that you might be facing a recession potentially in the US in the months ahead of us. I think we have to at least put a 50 to 60% probability to that, in which case then probably the risky assets will be hurt further over the next few months.
Wait, Ella, just to be clear, you see a 50 to 60% odds that we're going to get a U.S. recession in the next year?
Yes, I've tried to stay away from the R word, as they say. But I mean, look, we operate in financial markets. I like to think in probabilities. It's important to do so as your landscape is changing, as we were saying. So has your view, right? And so it hasn't been our core case for this year, I will admit, but it's certainly been increasing in probability. And therefore, the way we assess credit markets as a result also has evolved in the sense that you probably need a bit more premium, I guess, to own, particularly the riskier parts of credit, such as high yield.
So if you're at 60%, give or take, on a recession, that presumably makes the bond proposition, sovereigns, a lot more attractive, perhaps relative to high yield or to investment grade. So what does that do to treasuries at 60% probability for a recession?
Well, look, first and foremost, before answering that question, I want to say this remains a trader's market, right? So this is great for macro. It's great for people who can be active. And therefore, as a result, I think with this increasing odds, you probably have to trade that rallying for rates. So as you say, sovereign bonds look attractive here. Bonds have looked attractive to equities for some time now. And, as you've seen year to date, we've certainly outperformed. And I think that trend can continue. But, and this is an important emphasis, I don't know that that's the case for the rest of this year, because I do believe that policy responses will follow. That's number one. And second, on the fiscal setup, we are looking at the possibility of extending tax cuts in the US. So maybe that will buy us some breathing room. And last but not least, I don't see that if indeed this, let's say 50 to 60% odds of recession play out, I don't believe that we're looking for a deep recession. It's probably more nuanced in the sense of a shallow recession as balance sheets remain healthy, at least on the private side. And so I think with that in mind, I would probably say that you trade away from that. So initially we trade the rally in bonds, but I suspect later this year we might be flipping that view around.
Ella, just quickly, because we have seen some investment grade and high yield bonds waking up. Some of the spreads starting to widen yesterday, the biggest jump for high yields since August. Is credit finally waking up? Because spreads have been so tight even in the face of equity selling off.
Yes, and it's probably the most complacent view out there is that perhaps a little bit of widening, but no drama in credit. Look, in recession, credit moves, no doubt about it. So your excess returns look less attractive. And so you, as a bond manager, you have to give yourself some space here. Either increase your cash holdings, hedge some of your bets, or reduce some of your holdings, which are looking rich. So I would say yes, absolutely. And I think credit is pretty well held in general. So if there is a surprise in bond markets this year, maybe it will come from credit. I don't want to be very dramatic or dogmatic about it, but I'd certainly play the risks the other way.
No, you've made it very, very clear this is a trader's market, and perhaps to a certain leg lower, and this bond market is already in that price. Ella, thank you very much. Ella Hoxha of Newton Investment Management with her calls on the market. Waking up credit. Good morning from Bloomberg.
Welcome back to your brief. Let's take a look at some of the front pages this morning. The Washington Post leads with this on reports that the NIH will cancel or cut back dozens of grants related to vaccine hesitancy and uptake. People at the NIH and HHS did not immediately respond to requests from comment from the Washington Post.
Next up on Bloomberg, Russia says its air defense is down 337 Ukrainian drones. This was overnight. It seems to be the largest attack on its territory over the 3-year-long war. Now, the attack occurred as Ukrainian and U.S. delegations are preparing to meet in Saudi Arabia.
And the Financial Times has this, that Delta has cut its profit expectations for the first quarter roughly by half on weakening travel demand. It also lowered its guidance for revenue growth to reflect a $500 million reduction and for its operating margin. Let's get more on the story. Joining us now is Bloomberg's Benedict Campbell. Benny, just how weak is domestic travel in the U.S.?
So according to Delta, it's considerably weaker than they previously expected. The big takeaway from this is really that a couple of weeks ago, early in January, the company came out and said things are looking really strong, really robust demand. The visibility into the spring quarter is great. And here we are, sort of 6 to 8 weeks later, and we're faced with a very different picture. As you said, it's domestic travel. It's the leisure part of the market that is at risk here. Delta does a lot of domestic travel. About 50% of their business is on that side. So they're really quite uniquely hit by this. It's the transatlantic and the international business and the corporate travel that is still doing reasonably well. But this was a bit of a shock to the market. They said this ahead of a conference that's happening today in the US. It's a big aviation conference with a lot of executives speaking. So you might get similar comments from other airlines coming out of this. So Delta certainly set the tone, and it was a really negative one.
Benny, good morning. They keep the full year guidance the same, and that takes some of the analysts to the view that this is a transitory moment. Do the capacity that's been taken out of the system create some kind of a floor in terms of the overall earnings for the industry?
Yeah, you're probably right. If you look back into last year, we had a lot of overcapacity, and that was taken out of the market step by step. And you saw some really good numbers. If you look at companies like United last year, they had a really cracker end of the year. They did well. Delta, again, as I said at the start of this year that things are looking good. But for a lot of domestic passengers, flying is also, there's a little bit of psychology built into that. It is, do I have enough disposable income? Do I really need to take this trip? And then don't forget, we did have a number of really scary events in the US aviation market in the last couple of weeks. We had the mid-air collision in Washington. We had that Delta plane that landed on its roof in Toronto. And again, that contributed to it. The CEO came out yesterday and said, look, flying is still safe, but a lot of people, alongside looking at their wallets, might think, do I need to take this flight? Might I stay at home? I just don't feel very safe at the moment. So that also contributed to that.
Delta having a very painful reaction this morning, down nearly 12% at the lows of the pre-market session. Benny, thank you so much. That is Bloomberg's Benedict Campbell. Now, coming up, we're going to be catching up with Lori Calvasina as equities attempt to stage a rally. Will it stick? We're up 0.4% on your S&P 500 futures. Your 10-year yield, a little change this morning at 4.2%. This is Bloomberg. From our global headquarters in New York City, welcome to Bloomberg Brief. Danny Berger alongside Manus Cranny. Let's set your agenda.
Crawling back from the worst day since 2022. Futures rebound after the sell-off wipes out $1 trillion from the Nasdaq 100. Prepare for concessions. Secretary of State Marco Rubio outlines Ukraine's roadmap for peace. And Delta warns on the economy and cuts its profit forecast in half. Danny, good morning.
Good morning, Manus. Delta down sharply in the pre-market, but you might feel a little bit better looking at this. We are moving higher in the futures session. It is a Nasdaq 100 that's up more than 0.5%, but can it hold? We are now at a peak to trough loss of 8.5%, making it the biggest sell-off for the S&P since 2023. Tech was by far hit the worst. Nasdaq falling a whopping 4%, its worst day since 2022. Tesla saw its worst day since 2020. Citi cuts their view on stocks. HSBC cuts their view on stocks. You also had a bond market rally yesterday, the front end rallying by as much as 11 basis points. But we are calm, cool, collected this morning. We are little changed. We are under 3.9% for your 2-year yield and at 4.2%. Basically on the dot for your U.S. 10-year yield, Manus.
I love that, Danny. We're calm. That is like a paddling, paddling duck underneath there.
I don't know how long that lasts.
And we've just had a conversation with Ella Hoxha, and she said, look, this is a trader's market. She's not calling a recession, but the probability of a recession has risen in her view, 50 to 60%. How much of that is not in the credit market, but is in the sovereign bond market? That's the kind of dislocation, perhaps the next dislocation in these markets to come.
You're finally getting credit markets that are wakening up. Yeah. You're finally getting credit spreads that are widening. For high yield, it's their most since the summer of last year, but it's not really yet enough to ring the alarm bells. I think that's the interesting dynamic to watch. At what point does it move from a repricing to something that looks more panicky? And
I think you made a good point the other day. We were chatting to another guest about credit, and as Danny said, look, the credit markets are something a little bit different to what they were under Trump.
They're higher quality.
They're higher quality, perhaps a little bit of a moat in the financing there. One word of restraint from State Street, which is calm down. The S&P 500 is only back to where it was 6 months ago, but it's the speed with which we have repriced, and perhaps that's the more virulent point. So let's just bring that to Lori Calvasina. She is the head of US equity strategy over at RBC. Lori, good to see you. If anything, you've been absolutely stoic and on the button with your calls from the upside and US exceptionalism. Here we are. In the break we were talking about, you said it feels like a little panic. My question to you is, it feels like a little bit of a panic. When does it morph into something much more significant on the downside risk?
So look, it's a great question, and I think unfortunately we're at the battleground. So 5 to 10% drawdowns are not out of the ordinary, and we're getting close to that 10% mark. And what we've seen historically is when you do kind of get to that 8, 9, 10%, you get little hints of panic, and that's where something needs to change. If I think about my kind of bottoming indicators, things I've used over the course of my career, I would say AAII net bulls, you're at GFC lows. Unfortunately, you do tend to get stuck there, so you can't just sort of say we've kissed that low, we need to rebound. I really want to see the CFTC data on Friday, which will tell us what institutions were doing yesterday and what they continue to do today. That indicator on U.S. equity futures positioning has been like first, maybe second inning, if I'm being generous, in terms of unwinding from peak. So, but when it falls, it does tend to fall pretty fast and pretty sharp. So I want to see where that is. And if I think about earnings revision trends, that's another one that tends to be a good bottom indicator. And we're still sitting at like 42% upward earnings revision. So we haven't really downward adjusted earnings yet. So, and then I'm not going to try to predict the news flow, right? Yeah. But that has certainly been a big part of this. And I'll tell you, Manus, 2 weeks ago, I was on the road seeing investors. I'm not going to tell you which part of the country because I'll give too much away, but I was talking to investors, and it was the first time all year that I saw equity people say, maybe there's not a Trump put, maybe these tariffs are for real. Up until that, it had been insistence, this is just a negotiating tactic, and there's a Trump put, where is that? Let's debate that number. And and I think the administration, right, has been sending various messages over the last, kind of week and 24 hours, 3 days, whatever, and they're sort of sending that same message. So we kind of have to go through that, and we do need to see if some of the messaging changes.
Yeah, again, yesterday, a White House spokesperson saying we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from businesses and business leaders, and the latter is obviously more meaningful. I have to say, Lori, it almost rhymes with people who say the earnings are what's important. To your point, the earnings are important. We haven't seen a change. But considering what we heard from Delta yesterday, saying that the consumer is starting to look weaker, you and the team are really good at looking at corporate statements. Yeah. Are you starting to see the first glimmer of a change in corporate sentiment?
So I'll tell you, I wasn't doing a lot of reading of transcripts last week, but I was at the RBC Financial Institutions Conference, and they do a fantastic job every year of getting a lot of the banks together. And so they've got the big investment banks everybody looks at, but they do a great job of also getting the mid and smaller cap banks, which really have their pulse on the economy. And there was one company, and again, I can't talk about companies on live TV, but there was one company that said something that was echoed by a number of others. And and by the way, this bunch was pretty bullish on the new administration and the regulatory backdrop, okay? So it was a pretty friendly audience. But they were saying, look, all the stuff we're seeing, all the noise out of Washington, all the uncertainty that's emerged, it's having an impact on day-to-day conversations. And a couple of companies use the word pause. And I think this idea that we are undergoing a sentiment shock, we see all the different categories of vibes breaking down: political vibes and the net approval and polling data, investor vibes and sentiment and funds flow data, corporate vibes, have probably been the most resilient if you look at the consumer, the CEO confidence survey from Conference Board. But even there, they've taken a bit of a dent, and they're noticing that there has been an impact. And so we can talk about animal spirits all we want, but the reality is that consumer vibes, investor vibes, corporate vibes, those all end up potentially having an impact on business activity. So just because we haven't seen a massive deterioration yet, number one, doesn't mean that we won't see it. And number two, what I heard from the banks last week is that it may be starting. That this whole idea of, kind of the surprise, the confusion, the shock, it's at nothing else starting to cause some people to pause.
Well, certainly in the New York Fed, unemployment, delinquencies in credit, access to credit. I know it's New York as opposed to Michigan. Talk about the politics of Michigan. Tell me this: what we have is we've had essentially a blue-collar recession. We are now, the prospect is that a white-collar recession gaps down and meets the blue collar. So that is what is ahead of us, potentially ahead of us over the next 9 months. What is the consequence of that, the risk of that, and the consequence of that for how you invest?
So one of the things I've been very concerned about is that if you look at the Michigan survey in particular, and they do a beautiful job of sort of breaking out the different income cohorts, you could see this dominance and this kind of better vibe, so to speak, of the high-income consumer. And the low-income consumer was feeling worse, and then post-election, the low-income consumer moved up and the high-income consumer moved down. And now actually they're all stalling, so you're not even getting that recovery in the low-income consumer anyway. But the problem with that is that if you look at the S&P, It's really, if we think about those retailers and those consumer-oriented companies, for the last year, they've been telling us the low end was weak and the high end is strong. And so the overall consumer picture looks pretty good because that high-end consumer has felt great and they've been outspending money. And so the question is that going to hold up? It is the math of GDP. The math of GDP works differently than the math of elections. And that math of GDP, what I'm seeing in that sentiment data, is at risk. Now, again, we don't know, and I'll give the person who made that statement yesterday credit, we don't know to what extent that's impacting actual activity yet. We need to be very vigilant on that. But that is the risk in here, that we're taking this thing that has propped up consumer spending and propped up earnings and hurting it.
Well, maybe it makes sense then that the banks have sold off so hard, if that's kind of the vibe that's changing. Tech has also been hurt really hard, too. We're entering something that looks kind of like a tech bear market. In that kind of wreckage, is there anything attractive to buy, or would you hold off for now?
So, we've kept our overweight on financials on, and we've said, there's going to be some short-term pain there, right? Because the financial sector does tend to trade closely with the University of Michigan consumer sentiment data. So it is the plumbing of the economy. It is going to get hit by those vibes. But what I did hear last week at the conference was a very calm and confident set of management teams, and they're not seeing any kind of cracks underneath the surface. So I think they can manage through this, and there's probably a buying opportunity in there. And we have even noticed in our weekly this week, they were starting to get a little expensive and the valuations have started to improve. Now, tech is something different. We've been more cautious there. I think you've got international investors selling their U.S. stakes, and all the time I spend in Europe, and as I'm sure you know this well, like they want to talk to me about tech every time I go over there. It's tech, it's Mag 7, it's the growth trade. Right, and that's how they've been expressing their U.S. bets. We are seeing in the PFR data, they are starting to move in to Western Europe. They are starting to move into Germany. We are hearing from this administration, Europe needs to spend more in Europe. That doesn't sound to me like an argument for buying the U.S.
Really interesting. Lori, it is so great to have you on. Thank you so much for joining us this morning. That is Lori Calvasina of RBC Capital Markets. Let's now get some other stories that are trending on the terminal this morning. Volkswagen expects profitability to remain roughly flat this year. It's bracing for many challenges, from trade tensions to declining sales in Europe. The company is also under pressure to stabilize its performance in China, where it's been shedding market share to local manufacturers led by BYD.
Germany's Greens are hoping for an agreement in the dispute over defense spending. The party's co-head spoke to Bloomberg on how likely a deal could be.
We have been ready to negotiate since the night of the elections. We have been surprised that there has been nobody really engaging with us seriously.
Do you think it's likely that we could get a deal by the end of this week?
No, I really hope so. I'm like, the situation is dire in Ukraine. We really need Europe to speed up its own defense.
YouTube star Mr. Beast, his company, Beast Industries, generated $250 million in sales from its chocolate business, Feastables, last year. Now, over the same stretch, his media business, which includes his YouTube channel, his reality TV show, produced similar sales, but it lost almost $80 million, so he makes more in chocolate than YouTube, basically, is the read on that. Beast Industries is looking to raise a couple $100 million to expand its existing divisions.
That story actually makes you smile. There you go. Makes everybody smile. A little bit of chocolate. Coming up in the show, top business executives, they're heading to Washington today to meet President Trump. That business roundtable, what is on the agenda? We'll give it to you right here on Bloomberg.
This is Bloomberg Brief, and you're looking live at the Principal Room. Coming up later today, an exclusive interview with the Bank of America Retail Banking President, Holly O'Neill. That's at 7:30 a.m. Eastern, 11:30 a.m. in London on Bloomberg. It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York. Now, a rough ride for stocks yesterday. The Nasdaq falling the most since 2022. Downgrades abound. U.S. downgrading U.S. equities, saying U.S. exceptionalism is, quote, at least pausing. You also have HSBC saying that there are better opportunities elsewhere, also downgrading their view on U.S. stocks. In large part, some of that was in reaction to policy uncertainties and fears that President Trump's comments mean that he will not be stepping in to save this equity market. Let's get now to Washington, D.C., where Bloomberg's Tyler Kendall joins us. Tyler, we had a very large sell-off, and in Trump point 1.0, this might be the type of sell-off that people would say, surely Trump will step in and do something to save this equity market. Has there been any indication at all from the White House that they're willing to do something along those lines?
No, Danny, at this point, it does appear that the White House has sort of a higher tolerance during this term compared to the first term, giving us no indications that they even have plans to change how their policy rollouts have come out, and just with so much uncertainty that we know that the market would like to see and has contributed to this change in market sentiment. Now, we did get a statement that hit our inboxes yesterday right after the markets closed from a White House spokesperson who told us reporters that they want to emphasize, quote, that we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from businesses and business leaders, appearing there to blame emotions rather than fundamentals for this sell-off. And I can tell you that officials keep trying to point to us to recent investments that have been made under this administration. For example, TSMC last week with a $100 billion pledge as evidence that their policies might be contributing to some longer-term growth policies here. But the question really remains, at what point would the White House step in to provide some sort of assurances here? Or are they going to continue to double down on what has been their recent messaging, which is that this is part of a broader macroeconomic agenda and that consumers and investors alike have to be a little more patient? We could get some more answers potentially later on today. President Trump is expected to address the business roundtable here in Washington at 5 p.m. Eastern. It's a coalition made up of some top Wall Street executives. We're still chasing exactly who will be in that room, but no doubt, Danny, they are going to be looking for some firmer guidance from President Trump.
Tyler, let's just extrapolate that a little bit further. You know, the tech community or the billionaire community are $200 billion lighter in their pockets since the inauguration. That's the kind of number that's being bandied around. Jane Fraser and Jamie Dimon are going to go in there. The deal flow is lighter than they had expected. What is it that this roundtable will talk about? What do you think the show and tell will be in the press conference?
Right. Well, they're going to be looking for firmer assurances about President Trump's tariff plans in particular going forward, what sort of uncertainty we can see or what sort of reliability we could expect from this White House moving forward, because there's been a lot of conversations about how this policy perhaps has been going out of order here, right? That instead of first pushing forward perhaps tax cuts, we've seen so much uncertainty around that tariff agenda. But importantly, on those tax cuts, you have to remember that the last time President Trump addressed the business roundtable here in Washington, right before the election, that was when he had floated that he was going to cut the corporate tax rate. That was the pledge that he made during that meeting. That is probably something that they're going to want to know whether or not he's going to make good on that promise, as Congress continues to have disagreements already on how to get President Trump's tax agenda through. We know that right now they're considering the stopgap measure to fund the government through September 30th. That indicates to us that Republicans know that this is going to be a fight that is going to take many months to accomplish.
Tyler, elsewhere, we had Musk on Fox Business yesterday talking to Larry Kudlow. Let me just read you what he said. He said most of the federal spending is entitlements, so that's the big one to eliminate. Tyler, how is that sentiment going to be received on Capitol Hill?
Well, it also goes directly against a pledge that President Trump has made, which is that he will not touch Medicaid or Social Security. And this is going to be a very politically fraught issue for Republicans, but it is something that they already were grappling with before Elon Musk made his comments. We have to remember that the budget blueprint that they are working for in order to get President Trump's spending cuts and tax cut agenda off the ground currently allocates $880 million to the committee that oversees Medicaid to find those spending cuts. How the reconciliation process works is that committee is going to have to find those cuts somewhere. They could go to other programs, but the bulk of their jurisdiction oversees Medicaid. And just for example's sake, if $880 million in cuts went towards Medicaid, it would slash their annual budget by 10%. I was pretty struck by some statistics that came out by a database kept by NYU. 37% of House Speaker Mike Johnson's constituents in Louisiana are on Medicaid. This is going to be a very difficult vote, but at the same time, you have to balance it with fiscal hawks in Congress that are going to be looking for those deeper spending cuts, particularly to try to find these pay-fors, find these savings in order to get President Trump's tax tax cut agenda through, which brings us back to the beginning of the conversation, which this is really a big pillar of that macroeconomic plan, that fiscal agenda that this White House is banking on for long-term growth.
Yeah, in that interview, he says $500 to $700 billion worth of savings, but he calls it a money magnet for illegal immigrants. Definitely one to watch. Tyler, thank you very much. Tyler Kendall there, tracking the political stories. Let's pivot to the corporate side of the U.S. narrative. U.S. airline stocks slumping this morning. Delta slashed its profit forecast. You can see that Delta down almost 11%, and the rest are being dragged lower. Delta's sharp reversal from the start of the year when the CEO, Ed Bastian, gave an upbeat forecast. Let's get to Benedict Campbell. He's got the story. Benny, this is a dramatic reversal of optimism, clarity, and a roadmap at the start of the year. How much of this is to do with the political and economic uncertainty?
Well, if you listen to Ed Bastian, the CEO of Delta, speaking yesterday, actually quite a lot has to do with this. You've got to remember leisure travel in particular, domestic leisure travel, there's an element of psychology behind that. You know, it's discretionary spending. People might think twice where they put their dollars right now. We are in a phase of real uncertainty in terms of where the economy is going, where the stock market is going, where people's savings are going. And in that kind of phase, more people are halting their travel plans, or at least reconsidering them. And that is the sort of thing that is poisonous for the aviation industry. Delta was first out of the block with this one yesterday. There's a big JP Morgan conference this morning in New York with all the major airlines presenting, and you could well imagine more dire comments, particularly warnings coming out of that. So watch this space. As you said, we saw this trickle through the entire industry yesterday. Even over here in Europe, you look at big companies like IAG, like Air France, like Lufthansa, all down because that has a real chilling effect on the industry.
Benny, but how much of this, and we've seen this happen before with corporations, is just using it as an excuse versus a strategy pivot, strategy hold, something like that, that maybe is also affecting Delta?
Yeah, there is always that element. As you said, we've been there. You have these big external shocks, you know, be it the pandemic, be it, you know, the financial crisis, and then companies come out and say, oh, this was because, you know, issues that were beyond our control. Difficult to say this time, but the timing does give a sense that maybe they are onto something here, because just a couple of weeks ago, Ed Bastian said, things are looking great, the demand is there, the spring quarter's strong, we've done our homework, we've taken capacity out of the market, pricing is solid, and here we are now. So really, there does seem to have been an external shock. One of them, as I said, the concern about the economy, the tariffs. The other one, not to be underestimated, is the crashes that we've had in the US. The dramatic, you know, mid-air collision in DC in January, then the Toronto plane crash that involved a Delta plane, and more people anecdotally asking themselves, is this still the mode of transport that I would choose? Might I put off a trip right now? Do I really want to get on a plane? So these things do contribute. We'll get back to normal on that front, and if the economy does bounce back, or at least the sentiment, then people will start flying again. But right now, we're in a bit of a toxic mix of people worrying about the safety of flying and worrying about their bank balances.
As I say, a really dangerous combination. Benny, thank you so much. Bloomberg's Benedict Campbell. Delta shares down more than 11% in the pre-market. Should that stick, it will be the worst single day for Delta since 2022. Okay, coming up, retail earnings and data on deck will set you up for your day ahead on your Bloomberg Brief. Let's get you set up for your trading day on this Tuesday. We have some retail earnings. We're going to get Kohl's and Dick's Sporting Goods, all that before the bell. We're also going to get JOLTS. Those job numbers come at 8:30 a.m. Eastern. And finally, President Trump is set for a business roundtable of CEOs, JP Morgan, Citi, Cisco, among others. Will they encourage him to speed up some of the good stuff like tax cuts, Manus?
Yeah, well, the deal flow that they've had hasn't been up to par. A couple of stocks to watch. Tesla leading the Mag 7, stock rebounding after tumbling the most since 2020. That was a brutal day yesterday. Maybe the message from the president ready to buy one helped. Oracle down over 1%, extending post-earnings decline, Danny, after weaker than expected results. And Kohl's dropping ahead of their earnings. They're going to hit before the bell. Danny.
Meanwhile, just want to leave you with an image of the euro this morning. It is trading at 109. It is at the strongest level versus the dollar since November. Some signs that the Greens might indeed reach a deal with the German party in order to get more spending and deficits higher. All right, that is it for your Bloomberg Brief. Surveillance will take it from here.